you look at how much the market reacted, they didn't react that much. I mean, bond yield went up 5 or 6 bips yesterday on the 10-year, and the stock market is down 2%. I mean, it's not exactly an earthquake, and so I do think that the market is very rational and essentially discount a lot of the noise and look through it. The day where the market is really concerned about something. The second point, I think, is the currency barely move. I mean, I was looking at euro and sterling this morning. I mean, we flat as a pancake. And so the move away from the dollar, yes, as a secular trend, the fact that you want to diversify away from the dollar makes sense, and you want to have other currency than the dollar, but the dollar remains the real reserve currency of the world.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, it's back.
What's back?
It's back.
What's back?
They're back.
The bond vigilantes are
Sell
back?
America trade.
Oh, the Sell America trade.
Yes.
Various flavors of what the back could have been, but all seem to be converging at once.
Yeah, I should have been more clear. So we are recording this on January 21st, and this comes a day after we saw a pretty big sell-off in the market. What was interesting about that sell-off is it was a trifecta of U.S. assets. So you had the S&P 500 down, bond yields up, and the dollar index down as well. And so obviously people are talking about, is this the start or the restart of the Sell America trade? All of this is coming in the context of Trump's threats against Greenland, lots of geopolitical risk. And I should also just mention, we are recording this literally at the end of this discussion. Trump is due to speak at Davos. I don't know why we do this to ourselves.
Yeah, right.
So all of this could change on a dime within like 60 minutes, but there's a lot going on.
Yeah, and it probably won't change on a dime. And the reason is because, while yes, it is true that probably the tensions in Europe over Greenland, NATO, et cetera, are very important. Mark Carney having given a pretty extraordinary speech yesterday. There's also the Japan element and the rising bond yields in Japan, which is related to, Abenomics 2.0, perhaps, with the new Prime Minister and so forth. And so then part of the story yesterday, and you mentioned the trifecta sell-off, but part of the story yesterday, fairly sharp increase lately in long-end rates in the U.S. and Japan. The 40-year bond in JGB, which never existed up until like 2007, apparently, hit 4% for the first time in history. We were looking at sub-4% 10-year rates as recently as October in the U.S., actually maybe even as recently as December. Now we're closer to 4.3 again. So, those people who keep thinking like mortgages are going to come down, et cetera, it's not looking like it. So there is a lot going on in terms of potential theoretical drivers, et cetera. But the important thing is that rates at the long end keep pushing up, and people seem to be avoiding traditional safe havens.
Well, this is the debate, right?
Yes.
So Scott Bessent in Davos, like a lot of people at the moment, he thinks the U.S. Treasury sell-off was just, the Japan effect.
Yeah.
And others think it's a geopolitical risk premium. So, we need to get into all of this.
Yes.
And we have the perfect guest,
Yes.
really the perfect guest. We're going to be speaking with Manny Roman. He is, of course, the CEO of Pimco. So, Manny, thank you so much for coming on Odd Lots.
Thank you for having me.
Why don't we start with that last question? When you're looking at bond yields today, how much of that do you see as the geopolitical risk premium versus just a follow through from the Japan sell-off?
Well, I think the honest answer is it's a mix of both. But when I was listening to you, and when you look at how much the market reacted, they didn't react that much. I mean, bond yield went up 5 or 6 bips yesterday on the 10-year, and the stock market is down 2%. I mean, it's not exactly an earthquake, and so I do think that the market is very rational, and essentially discount a lot of the noise and look through it. The day where the market is really concerned about something, you're going to see a much bigger reaction. That's the first point. The second point, I think, is the currency barely move. I mean, I was looking at euro and sterling this morning. I mean, we flat as a pancake. And so the move away from the dollar, yes, as a secular trend, the fact that you want to diversify away from the dollar makes sense, and you want to have other currency than the dollar, but the dollar remains the real reserve currency of the world. And so I take all of this with a grain of salt, and
Sure.
and you know, we animals in the best possible way, and we look at the screen and we tend to overreact to what we hear, and so on and so forth.
I was thinking about this last night, looking at the S&P 500 falling.
You were thinking about how you're an animal looking at the screen?
I was thinking about I wasn't in a moment of being an animal looking at the screen last night. It did occur to me, as like, okay, S&P had fallen 2% on Tuesday, the 20th. However, in the context of an incredible year and an incredible 15 years,
and
or
a
maybe
market,
an incredible it's not that much. Nonetheless, I guess it's the confluence of headlines coming together. It's like, oh, I'm going to like pay attention to this 2% down day. But I certainly take your point. These are modest moves in the grand scheme of things. On the other hand, this upward pressure that we continue to see on the long end of curves, setting aside 1 week or whatever, whether we're talking about Japan, the U.S., elsewhere, like, what is the bigger story that we're like taking from that?
Well, I think Japan is quite a peculiar situation. So,
okay, let's talk about Japan.
Let me start with the U.S. because it's
Okay.
it's the easiest thing. Look, rates have been essentially in a range for the past year and a half, and I think the Treasury and the Fed would be very focused on the long end of the curve, and I think that fixed income offers a real good entry point in terms of investment. I mean, we talked about the S&P. The S&P is very expensive. Investors are going to look at, long-term fixed income and say, I can make 6 or 7% holding a basket of fixed income. That looks really attractive. And so I think every time yield back up, you see money coming back. I talk about Pimco. The flows have been incredibly good over the past 12 months. People have come and bought U.S. asset, and the trend is very clear. Nothing is changing, and we have people basically saying, I can get, equity-like return using fixed income. And for as long as that remains the case, I think the rates are very bounded in terms of where they're going to go.
Okay.
Japan is a very specific situation. I just came back from Japan last week.
Oh, great.
I mean, you feel bullish. I think everyone you meet is bullish equity. I started my career in 1987. It's the first time that I see the Nikkei above when I started. I mean, it's unbelievable. But yes, there is for the first time inflation, and the long end of the curve is probably going to go higher, and that's probably overall a good thing. Now, the super secular trend is the demographic pressures are a real problem. But I think one of the things we try to do is look at the liquid instruments. So the 40-year JGB may not be the most liquid instrument. The 10-year JGB is a
Sure,
real,
I agree. The 40-year, they're probably hardly trading.
Yeah. And the same goes in the U.S., right? I mean, you really want to look at the 10-year. The 30 is a bit of a different story.
You mentioned U.S. Treasuries trading in a band, and this is something I wanted to talk about because, before yesterday, the non-movement in the bond market was really remarkable. So the MOVE index is at its lowest since, I think, like 2021. That's the bond volatility index. And if you look at the 30-day trading range for 10-year Treasuries, that was at the tightest since the 1970s, which is pretty remarkable. What has that lack of volatility been like for a big bond shop like Pimco?
It's a funny thing. We do like volatility because with volatility comes alpha.
Right.
And so we do like the opportunity to provide liquidity and add interesting position to our portfolio, for sure. But we need to scale up and scale down the risk depending on what's happening in the market and depending on the opportunity. And so we just came back from a very strong period of performance. There's going to be plenty to do. And it may be on name specific, it may be on macro trend. I do think that a competitive edge is not to be able to predict day to day what's going to happen to the market. Our competitive edge is to have structural position, to think about where value is, to optimize our portfolio, to think about the downside risk. That's what we know how to do. And, it's an interesting market. Some things are cheap. I would say rates are cheap. and some things are rather tight. Investment grade are probably rather tight, but in structured product and mortgages, there's a lot to do. So you have this environment where you can build portfolio and sort of feel reasonably comfortable that you will perform over the next 12 to 24 months.
Let's talk about go back to Japan, since you just got back from Japan. And actually, I don't think we've done an episode on Japan since the election of the new prime minister. But tell us a little bit more. I mean, why now? What's going on? You say everyone feels bullish, et cetera. Tell us a little more color of what you learned in your trip to Japan.
Well, I mean, look, we have a big Japanese office, and there are people in Pimco who knows a lot about this. I mean, look, it's for 20 years, Japan has tried to restart inflation, and for 19 years, it really hasn't worked. And then all of a sudden, they managed to get somewhere in a labor market which is fairly tight, where immigration is a problem, and where when you go there, I think there's a clear desire to monitor immigration, and the new prime minister has been very vocal about making sure that there's a limit in terms of labor force moving into Japan. Now, over the medium term, that's a problem. But when you look at the inflationary pressure, it's pretty clear that there's more inflation in Japan than there has been for the longest possible time. Now, the second thing is, I think you see other factor in Japan that you haven't seen in a long time. I was surprised by the fact that you have much more activism in the stock market, people to try to take ownership in company, trying to turn them around, breaking down conglomerate. It's not the first time I hear that. But I think this time it's certainly more real than it has been. And then when you think of the AI robotic trend, the one thing Japan knows how to do is to make things and to make sophisticated product. And I think that all of a sudden, there is a competitive edge that Japan has in terms of a number of stock which looks attractive. Forget about whether they price, right or wrong, but in terms of business model, they're quite attractive.
Just on the bond sell-off, how much of that is the return or expected return of inflation versus debt sustainability concerns? Because this is the other thing that's been very long running in Japan. You always hear it's a heavily indebted country. Is this, maybe the bond vigilantes finally turning their attention to Japan?
So I was talking with Rich Clarida, who is our chief economist.
Friend of the pod as well.
Friend of the pod. Yeah. And I said to him, we tend to look at debt to GDP. What if we look at debt to household savings? And then you realize for both the US and Japan that there's just a lot of money. In the US with the baby boomer, in Japan with savers who tend to not to spend enough. And if you believe in fiscal policy and the fact that eventually taxes will go higher, then I think that the dynamic becomes quite different, and you can have higher sustainability in terms of debt because the ability to collect money is there. You look at the US, for example, you could have at some point in time higher inheritance taxes. There's $80 trillion of wealth in the baby boomers. Eventually, that will go to the next generation, but it will also go to the state. And it's a question of how much goes to the state versus the next generation, but there is the ability to tax more.
It also comes down, I suppose, to the political capacity of the state to tax. Because on math, you say, look, there's tons of private household assets. We've far more wealth than we do have debt as a society, and therefore it's just a matter of channeling in the right place. But you also need the politics to rebuild, which actually gets me to a question that you might have putting on the sort of like CEO of a big asset manager hat. In California, there's talk about a wealth tax, et cetera. There's talk in Europe about wealth taxes. There's people talking about, I want to set up my family office or whatever somewhere in the Gulf and avoid all this. What do you see on that front? Do you see money moving in a significant degree? High net worth or ultra high net worth clients are really thinking about where their money is domiciled in a different way?
So you knew there was something good about me is that I'm French, and so I've seen firsthand the experience of a wealth tax.
Yeah, tell us more about that.
Well, it turned out to be a disaster because the reality is people can move, and they decided to vote with their feet, and they didn't believe that the government would keep the taxes at, historically 2 to 3% of wealth, and they decided to go to Belgium or to Switzerland and to other places and so on. So I think the evidence in terms of how well wealth tax work is quite mixed. In California, you can cross to Nevada and decide you want to live in Nevada, God forbid.
But then you have to live in Nevada.
But you got to live in Nevada. But there are many other places, and there's anecdotal evidence of people moving to Austin and domiciling themselves in Austin and so on and so forth. And so I think one of the things about the U.S. tax code is you have competition among states in terms of where people can reside and so on and so forth. Now, there's many great things about California. We're based in Newport Beach. We're happy to be in Newport Beach. We pay high taxes. It's all good. But
do you see in, say, California, or even on right now, are you getting, interest from, are you hearing about high net worth clients making these decisions right now or thinking about that?
All secondhand and all from the tech industry.
Yeah.
And I read the same news than you do.
Okay.
I'll be honest with you. I never met Larry Page, but I understand he moved to Texas, and And we, by the way, one of the things we've done really, really well is we set up an Austin office, and it's been a great success. So we have 500 people in Austin. It's a big business for us. There's a great university there which produces a lot of grad in STEM.
Joe's aware of
That's
it.
my alma mater. So
is it?
Yeah.
Well,
so
here we go.
Thank you for saying that.
Here we go. 90% of the graduate from UT stay in Austin. So you're one of the exception. Because that was one of the pitch.
I deserted my fellow
got
alum.
out.
But it's been a real good thing for us.
Yeah.
I want to go back to the Sell America trade and dollar diversification, because one of the things that I think contributed to the atmosphere yesterday was we saw a headline about a Danish pension fund selling its treasury holdings. I think they have 100 million or something like
so
that.
Not mega.
Right. So a drop in the bucket
Symbolic,
of the
maybe.
U.S. Treasury market. But the fact that a pension fund is saying we're going to get rid of all our exposure because things are just too unpredictable obviously feeds into concerns about, again, that geopolitical risk premium. When you see a headline like that, what goes through your mind?
Well, that there's an upset Danish pension plan for a reason that I think we can understand, but that in the large scale of thing represents absolutely nothing. And one of the things when you work for Pimco that you see is country with high savings rate and low population, Canada, Australia, need the US to put capital to work because the local market is too small. So imagine, for example, that you are one of the superannuation in Australia. The reality is you need the US to put money to work. Your local market is too small. You're not going to put 50% of your assets in Asia. And Europe, I don't know. I mean, I'm European. There's many things that I love about Europe, but the investment opportunity may not be as exciting as it should be. We haven't seen growth over the past 6 years. It's a problem. So, the other trend which is happening exactly at the same time that we've been very involved with is the AI build-up. Mm-hmm. And the fact that at the same time you have the Sell America, at the same time you have an enormous amount of money coming into AI and data center and building up a whole new ecosystem. And that, I think, will provide exciting investment opportunity for plenty of people. And so you have to weigh the two, and the micro versus the politics. And if I was a guessing man, I think the macro wins.
Nonetheless, I'm going to still try to goad you into the politics-ish question because we're very flattered that you came to visit us here at our offices in New York City. But it's hard not to note that you're not in Davos right now. I was there in 2015. I got a flu, so I vowed to never go again. What's your excuse?
Oh, my excuse is, look, I always say my partner Diane Everson, who was on your pod a month ago, and I. Look, our life belongs to a client. We're here to manage the firm. We're here to sort of.
Aren't they all in Davos?
Yeah, this is what they. This is why a lot of them are saying, "Oh, I go to Davos because this is where my clients are."
Networking.
Yeah, networking. Why is Jamie Dimon's there? He would say, "My clients are here. I got to meet with them." See, what's your excuse?
Simple people. We mind the shop. We mind the shop, and look, people make different decisions, and so on and so forth. And I given what's happening in the market, given everything else, I think we're glad we're in the office.
I love being in the office. That being said, Tracy wrote about this yesterday in our newsletter. You know, it's hard. The conversations that are happening in Davos, they're pretty serious. I mean, Mark Carney talking about this sort of, it's time for us to not be a rupture. It's time to us to not, we can't be nostalgic about how the world was 5 or 10 or 30 years ago, et cetera. But it's hard. Markets don't, like when we, markets don't easily price in geopolitical turning points, or when they do, it tends to be in an L shape, et cetera. Surely you're like thinking about these things
all the time. And look, Mark Carney is a friend. He used to be on our global advisory board. I think he's a fantastic human being and a great Prime Minister for Canada. But I will read the transcript of his speech at the same time you will.
Yeah.
And I understand the predicament. Now the question is, how much Canadian bonds do I want to own, and how much Canadian dollar do I want to own? And information is very, very efficient. And the reality is Mark says to everyone at the same time what he thinks, and that's the way it should work.
How do you actually factor in geopolitical risk into the way you manage your portfolios? Because this seems to be something that investors understandably struggle with, especially since a lot of the outcomes are so binary, right? It's like, well, either the U.S. takes over Canada or the U.S. doesn't take over Canada.
I think we try to be incredibly humble and say, where do we have an edge? And the reality is, if the three of us sees the exact same thing at the same time, we don't have an edge. I think we really, really try to understand politics. We have one of my partners, Libby Cantrell, is solely focused on U.S. politics. She does a great job. We care, but we care about macro issues that may not make it to a pod. We care about mortgage reform. We care about, what can the president do in terms of Greenland? The reality is he needs 2/3 of the Senate and Congress approval. That seems like a lot, So we care about smaller things, and often we said, look, we don't know anything that the market doesn't know, and so we shouldn't build position based on politics, because the reality is we all see the same thing at the same time. And in some markets, I come back to currency.
Yeah.
I mean, you look at the big currency, it's the most efficient market in the world. I mean, if you look statistically, they're incredibly hard to predict. I mean, you look at time series of, dollar yen or dollar sterling or dollar euro and so on. I mean, it is as close to white noise as anything can be. So you build a portfolio. Yes, there is a theme that the dollar may get weaker, in which case you want to have other currency. We like the Australian dollars. We like the British pound. Why? Because the economy is slowing down and you have high rates, and so there's plenty of room to cut. And you say to yourself, that's something you want to own. But, how much of your portfolio it is, 20, 25%, something like this. It cannot be 100.
What do you make of the relentless bid in gold?
I am, honestly, there's things where I just give up and I say,
really?
And I say, I don't understand. That's one of them.
Really?
Yes, totally.
Say more.
I believe that assets are being moved by two factors, valuation and momentum. So the momentum in gold is incredibly strong. I see it goes up every single day. Someone is buying it. Maybe it's CTA, maybe it's individual, maybe it's central bank. I don't know. When I don't understand, I stay on the sideline. By the same token, I don't really understand crypto, and that's okay.
Yeah.
I think, when you're in asset management, the one thing you need to know is sort of stick to your knitting and do what you know how to do. And when you don't understand, sort of say, okay, that's not my gig. I shouldn't be doing this. Other people understand it better than I do.
I think you gave us a very polite prompt earlier to talk about mortgages and mortgage reform, and we should do that because I know that Pimco has been very bullish on mortgages recently. I see a Bloomberg headline just from last week saying Pimco sees mortgage rates easing on Fannie Freddie purchases. Those are part of the Trump administration's efforts to bring down mortgage rates. But of course, at the same time, you know, we started out this conversation talking about the 30-year yield, which is ticking up. How are you thinking of, I guess, those two tensions in the market? So the efforts on the political side to bring rates down versus bond yields, longer term bond yields that seem to, you know, be pretty stuck at high levels.
That's right. That's right. Look, it's a complicated tension, and if you put yourself into the shoes of the U.S. administration, what looks clear to me is you want mortgage rate to be lower rather than higher. And for that, part of it you control and part of it you don't. And it's inflation expectation, it's the shape of the curve, and it's discipline. And whether they get there or not, I don't know, is the short answer. 30-year mortgages and the whole mortgage ecosystem looks cheap, and there's plenty to buy, and it looks attractive. Yes, we do think that the purchase will help in terms of valuation, but I don't know what I don't know. You have midterm coming in November. It's too early to have any intelligent thing to say.
One of the things that we heard last night, or one of the things that we've heard over the past several weeks, the administration wants to make it harder for big asset managers to buy single-family homes. That might have something to do to actually do anything like that. Might have to go through Congress, but we did get an order last night, or a statement last night from the White House talking about Fannie and Freddie putting bigger constraints on large institutional investors. Like, what do you make of some of these, I don't know, populist-inspired impulses to sort of change the distribution of who could buy what assets?
Not much.
Okay. Why?
Is the honest? Well, I mean, look, we don't do that, but there is, some people do build to rent. Or,
and they said build to rent's exempted, so I think that's already a pretty big chunk of like what this whole phenomenon is anyway.
And look, it's hard work.
Yeah.
I mean, it's can the U.S., if you look at it from a macro standpoint, has a shortage of house, right? So we need more homes. And the reality is, when you look over the 30-year period, the only places where costs haven't gone down is building, And the reality is we need more cheap houses, especially in affordable housing. And that's a policy that I think would be quite good. But it's not because, institution shouldn't own single house. You need more houses. You need people to be able to afford proper houses, and that's true, I think, in a lot of states. And there are states like, Texas, for example, where you have plenty of space, and you look at the cost of housing, and it's going down. And you have, states like California where it's really complicated.
You need the robots to build houses,
That's right.
So, okay, speaking of robots, AI has come up a couple times in this conversation. One of the interesting things that's happening in the credit market right now is that AI is becoming a much bigger force when it comes to investment grade debt. So lots of big companies issuing even more into that particular market. How does that change the credit market, if at all, for you? How are you thinking about the increased, I guess, exposure or presence of AI in something like IG?
Well, I think you reported, we try not to talk about single positions, but you reported that we got involved into a very large $20+ billion transaction to build data center. And some of these deals are going to be incredibly attractive and some won't be. And so I think what's really interesting is the big data center user may actually be AA or better rated company. And so Oracle or Meta or any of these companies actually have a capital structure where they may need a lot of money, but the money is backed by market cap if you use a Merton model, which is above $1 trillion, and so they're pretty safe investment, and so that's pretty unique, and so size is a competitive edge that plays well to our strength, and so we're positioning ourselves to have plenty of capacity to do it if and when it comes. And then some people like Microsoft and Google probably can do it with their cash and build up their cash and don't need to issue debt to be able to do it. So different people will go with different strategy.
My understanding is you made a pretty chunky return already on that data center deal. And I've heard in the market that since you did that, everyone wants to come in and finance data centers. Are you seeing a lot of copycats or competition in the space to get on these new deals?
Well, not everyone can take $25 billion of a deal.
True.
And so I always say, one of the things with Dan that we constantly think about is what's our competitive edge? And we're big. And we do one thing, we do fixed income in all shapes and form. And so we always say we're going to make money where our strengths are, and that's clearly one of our strengths.
It's good to be Pimco when it comes to new issuance, for sure.
It is good to be Pimco when it comes to new issue where we were part of the structuring, working with, in this case, Morgan Stanley, and we understood the credit quite well, and it was something which fit into a portfolio. It may very well be that the next one doesn't fit into what we do, in which case we'll pass. And
returns to scale are such a common theme in our discussions last night. Size per se is a competitive advantage, which is not always the case because sometimes you like to hear, we're small and nimble, but it seems like in many of these things we're talking about these days, size is huge. Just like from the perspective of CEO, and this conversation sort of blends the line of like what I would think of as a CEO discussion and CIO discussion, right? When we're talking about rates, it's a CIO discussion. When we're talking about where you have offices in Austin, that's kind of a CEO discussion. But from the perspective of CEO, like where else are you putting your chips? Besides, you mentioned Texas, and there's some migration.
I think Asia. I think all the high growth market from a CEO standpoint is quite interesting. So we have a great Asian business. And when you look at the population, the savings rate, and what it will be 10 years from now, I think it is incredibly important that we do extremely well in Asia. And so we have offices in Japan, Hong Kong, Singapore, Taiwan, Australia, and they're doing great. And the buildup of wealth is really, really important. And that's before we start talking about China. And so if you look at the super secular horizon, Asia will become significantly bigger than Europe in terms of the amount of money for asset manager and where the opportunity set is. And I think that's pretty clear to me.
Do you anticipate mainland China ever being a bigger opportunity?
I hope so. I hope the market offer a level playing field at some point in time and something that all of us feel comfortable investing in.
What would make you feel comfortable? Is it just the easing of capital controls or
the easing
something
of capital
else?
control, the rules in terms of setting up proper trading operation, all of these things. And I always say you can break the world differently. So you look at our business.
Yeah.
I can break it and say you have high growth region, Middle East, Australia, Canada, Asia, where they all have the same characteristics. They have high growth and high savings rate. And those are, usually pretty good for asset manager.
Yeah, but
And then you have mature market like US and the UK, where you'd be happy to grow at 5%. Because, there's nothing really new happening, and the market is the market. You may take market share, you may lose market share, but the secular growth in the markets is sort of well known.
And what about in the Gulf?
I think the Gulf is very exciting. I mean, I always make this joke. If you close your eyes and you take a direct plane from LA to Abu Dhabi, so as you know, we're in Newport Beach.
Yeah.
Honestly, you think you went around the world and kind of came back.
Abu Dhabi is the LA of the world?
Well, it's very similar to Newport Beach, actually. People are super friendly. They've done a really, really good job.
Super friendly, great weather. and the most interesting culture and intellectual hubs that you can think of when I associate Abu Dhabi and Newport Beach.
I mean, Abu Dhabi is, once again, over the super secular trend, I think the Middle East has come a long way. And I think you also you have a new generation of investment professional, locally trained and locally raised, which is pretty good. And so, once again, I think that's quite good. And then there's what we don't know, everything happening with Iran and whether Iran is something will happen or not. And, I think the honest answer is no one knows.
I lived in Abu Dhabi for 2 years, and I always likened it to Texas in that it's hot all the time, and you spend a lot of your time at the pool and at the shopping mall, and that's pretty much it.
Oh, that could be California.
Exactly.
Just as much. Yeah.
Exactly. Since we're on sort of CEO executive level topics, just on AI, this is a question we've been asking a lot of our guests, but how are you incorporating AI, if at all, into your own workflow and organization?
Oh, I think for us, the sort of defensive and offensive opportunity. So the defensive one, it should increase significantly productivity in terms of everything we do, from the way we manipulate document, the way we create marketing, the way we optimize our trade function. I mean, remember, every time we buy a bond, it goes into many different accounts. And every single account has different parameters, different restriction. It all goes to a custodian. It gets split. It has best X. All of these things is a complicated factory. Anything which makes the factory simpler, more efficient, and safer is a really, really good thing. AI will help to do this. We spend a lot of time discussing NDA and things like this, where honestly, it's probably fair to say that we have better things to do. And so if AI gets us to a more efficient and less costly solution, that's good. I always say if AI allows us to reallocate resource more in R&D than in repetitive menial function that we don't need to do, that's good. I think compliance will also benefit quite a bit from AI and the ability to do deep learning and sort of figure out whether they trend, whether we miss something, whether, look at every possible situation. I think that's also quite good. And then there's the offensive part where you sort of said, okay, can I use large language model to try to extract from data insight and opportunity that I may have missed? And I think on this, some of it will say, okay, that doesn't work. Yes, we've analyzed every single sentence from the Fed and every single transcript, and we found nothing that we didn't know. And then sometimes we may find things that are new and allows us to have an additional alpha. And I do think that large language model have a competitive edge when you have a lot of data which don't necessarily match perfectly. So when it's, in the mortgage market, you have your house, your mortgage, your credit score, a picture of your house, your insurance, your employment history, your communication with your mortgage provider. All of these things, I think, should give us a finer assessment in terms of what's happening. And then the more data you have, the more of an edge, presumably, you get. But I think you embark into this journey being humble and sort of hope that, you have a few win.
Just on the, I suppose, defensive AI, because we just recorded an episode talking about some of the coding models, and there's a huge theme in the stock market, specifically lots of sort of mid-level enterprise software companies get very hurt because their clients are like, well, maybe we could buy this, or maybe the AI, we don't need to put in a sales ticket into a system because they can have an AI that just knows that tell the salesperson to make a call, et cetera. On this sort of basic blocking and tackling at an asset manager, you must have tons of third-party enterprise software contracts and seat negotiations, et cetera. At that level, do you see AI tilting the playing field and said, you know what, maybe we could build this feature trivially and we don't need to pay this per seat license or anything like that. Are you seeing this in action?
I think you're totally right. I think that all of us have apps that we use and software that we use that we don't love and that cost too much money, and we'll try to replace them. And some of them you'll be able to replace quickly, and some of them you won't. But
that's an effort. There's that's a real thing.
In-house development, is that something you're doing already?
Sure.
Interesting.
And I think to link that back to the market,
sure,
there's been quite a high level of activity in private equity in software because the cash flow were deemed to be predictable with high leverage. It will be interesting to see what happened to the returns of this software company for the years to come. There'll be winners and losers, but the top line of some of the software company will be interesting. And I know that Dan is worried about the software industry in terms of risk, and every single credit we own, we look at it with an air length and say, if AI is as game-changing as we think it is, what would it do to this business model? And I think that's a perfectly reasonable question in terms of what it may do.
You mentioned the Fed a little earlier, and I realize we've gone this entire conversation without actually talking that much about the U.S. Central Bank, but let's rectify that now. So one of the remarkable things about the bond market recently is even though there have been concerns and headlines around central bank credibility and possibly Powell, coming under criminal indictment and all of that, the bond market hasn't really reacted that much. Again, it's been trading in a very narrow range. We've also seen TIPS and other inflation-related bonds basically not incorporating any of what you would think would be these political risks. Do you worry at all about credibility of the central bank as a big bond buyer?
I think we are. I think we believe in Fed independence. And as we often say, I haven't met many politicians who want higher rate. And so there's two levels in economic policy. There's monetary and fiscal. You want the Fed to be in charge of monetary policy. And I think the good news is whoever gets the job as head of the Fed enters into the history book. I think the weight of the function is such that people tend to make very rational decisions. It doesn't mean that they're always the correct one, but you're not going to see a situation where, with a reading of inflation, they make totally suboptimal decision for political reason. I think it's very hard.
You think we're far from that?
I think it's very hard to do.
Okay.
And you have a voting process. I think when your chief economist tells you you're crazy, it's just really difficult to kind of go against this. Now, maybe once you can kind of look through the data and say, I do think the data are going to become better, here's why. But it's a really, really dangerous game. Also, once you lose credibility, you really lose credibility.
Yeah.
And I often say, I think everyone has looked at the Liz Truss situation in the UK and how when you do something borderline crazy, in literally 5 days, you can destroy your credibility on the bond market, and you have to move at the speed of light and with the Bank of England to be able to correct when rates go up literally 100 bips. And so I do think the market punishes you and punishes you really hard if you try to do something which it doesn't want.
All right, last question from me, because you mentioned Liz Truss. Why is it that Liz Truss is like, okay, this was like a dangerous thing, it was like reckless, et cetera, whereas new Prime Minister of Japan comes in, talks about reflationary policies, and you describe it as like everyone's excited about Japan right now. What is the difference between the inflationary impulse that Liz Truss was expected to have accelerated with the mini budget versus maybe the more benign reflation that you're mostly describing as a sort of positive development in Japan?
Well, I think what happened is she gave this whole tax package at the same time. So she wanted, there was like this liberalization and at the same time a tax package where clearly someone hadn't kind of figured out the very basic math in terms of what it did to government spending.
Yeah.
And then all of a sudden you had a huge deficit that the market saw and say, oh my God, there's no way you can do this. This is not realistic. And the back end of the curve just went crazy. I mean, at some point in time, fiscal policy really, really matters. And look, one of the things about being European is you look at fiscal policy quite a bit because that's been one of the core lever of economic policy. And somehow, I think the left hand and the right hand forgot to talk to each other, and they came up with a package which made no sense and clearly hadn't been blessed by the UK Treasury, and the market reacted incredibly strongly to that.
I'll ask one more question, which, I think when it comes to Pimco, I think it's often underappreciated how much of Pimco is about those sort of overlays on top of the fixed income positions. And so I have to channel my inner Bill Gross here and ask, are you selling volatility into this particular environment?
Well, I think we look at volatility all the time, and I think when we find opportunity to sell volatility, we do, and it's a source of alpha. And I think we've done it for a very long time. And sometimes we think it's attractive, and sometimes we think it's less attractive. And I'm not going to talk about a position, but
Sure.
but it is a source of risk premia, and I think we focus on it. I think to kind of come back to this, we hit single, right? And I think what makes our performance is really the work of 300 people on the Dynavisin, but we hit a lot of single well, and when you put all this single together, the result is pretty good. The great man coming down from the mountain and thinking that all these great macro trends are going to happen, that doesn't quite work. It's really about being incredibly disciplined and essentially making a bit of money every single day with various different levels. And maybe I demystify what we do, but I think it's actually a lot of work, and that is why it works, and it's repeatable. I always say to a fund manager, why do you think you can make money? Question number one. Question number two, why is it repeatable? Why do you think you can do it again? And the great idea and the great man coming from the mountain, with the table of the laws, I'm not entirely sure it's that repeatable. Because sometimes you get lost in the burning bush and other things and so on. And
these are very evocative images.
Yeah. I'm an evocative guy. and I do think repeatability is really, really important. You want to make the process as industrial as possible and sort of say, okay, those are all the levers I have, and on average, this is going to be pretty good.
All right, Manny Roman, thank you so much for coming on. It was
a real
really
pleasure.
fun.
That was fantastic. Thank you so much.
Joe, that was a really enjoyable conversation.
Yeah.
And I like straddling the CEO and CIO worlds. It was interesting to get that perspective. One thing I saw right before we recorded this episode, people were talking about the Bank of America Global Fund Manager Survey.
Oh, is that out today?
I don't think it's out, but in the last one, relatively recently, I think, geopolitical conflict topped the list, which, kind of expected. But then the second biggest concern was a disorderly rise in bond yields.
Interesting.
So 19% of respondents had that down as their top tail risk in January. That's pretty interesting to me. And the atmosphere feels a little bit different because people are so primed for this particular event.
Totally. The thing that I keep thinking about is we just have this combination right now of all right, so and we didn't ask Manny this directly, but it's this fundamental question: why does the neutral rate appear to be higher than it used to be, right? And there's two big things going on, which is there's a lot of public spending because of remilitarization, and that's related to geopolitics, this desire for national self-sufficiency across a range of technological and commodities and so forth. So there's tons of spending. And we're throwing sand in the gears of trade. So that spending is less efficient than it otherwise would have been, right? So for $1 of spending, maybe only 75% is actually contribute to the economy and 25% is waste, et cetera. So these are two things going on at once. And so like I certainly take Manny's point, and I think it's totally right. There's like you can't one day you get a blip and it's like it's not the end of the world. And you have to like train yourself to like not overthink a single day. On the other hand, rates around the world remain, despite rate cuts, et cetera, and despite arguably a slowdown, significantly above where they were pre-crisis.
There's a direction of travel.
There's a broader direction of travel that strikes me as very intuitive, given the simultaneous phenomenon of like less efficient trading systems and more spending.
All right, I see Trump is giving his address at Davos. So shall we leave it there?
The another man from the man. Can I just say I loved Manny's like Man of the Mountain. I feel in finance we're always talking about Men of the Mountain coming down with their wisdom.
Yeah.
So I love that. But yes, we should go listen to a man literally in the mountain right now.
Lots of mountain men in Davos.
And hear what he has to say.
All right, let's leave it there. This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our producer, Carmen Rodriguez, at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks.
And for more Odd Lots content, you should definitely check out our daily newsletter. You can find that at bloomberg.com/oddlots.
And you can chat with fellow listeners 24/7 in our Discord, discord.gg/oddlots.
And if you enjoyed this conversation, then leave a comment or like the video, or better yet, subscribe.
Thanks for watching.